Also remember, this is an election year. There's a potential for uncertainties or surprises to kind of keep the market choppy. We have a cycle composite that we put together, the 1, 4, and 10-year cycle, to sort of give us a roadmap for the year, and it suggests a fairly choppy uptrend. You have correction potential in May, September, October, but then after the election, there's pretty reliably a year-end rally, and over the course of the year, we see the market moving higher, as it's already started to do up to this point of the year.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hello, everyone, and welcome to Interactive Brokers IBKR Podcasts. I'm Jose Torres, your senior economist, and I'm joined today by the Chief Global Investment Strategist at Ned Davis Research, Tim Hayes. Welcome, Tim.
Thank you.
Our pleasure. So let's get straight into it with a global growth question. The World Bank predicts that global growth is projected to slow from 2.6% last year to 2.4% this year. How has that influenced your outlook for equities and bonds? Does developed or emerging markets outperform?
I think it will be a positive environment for both stocks and bonds, in that the slowdown is enabling the central banks to cut rates and provide liquidity. Really, the question is more about the timing of that rather than whether it will happen. And you have to have enough of a slowdown to support that development. And bonds will benefit as yields come down, but equities will tend to outperform bonds as they rally. So this is evident in our recommended allocation, which is 70% stocks, 30% bonds, and 0% cash. And that's based on a benchmark allocation of 55 stocks, 35% bonds, and 10% cash. So we, on the question of developed versus emerging, we are overweight the U.S. We've been overweight the U.S., which is about 64% of global market cap. We've been overweight since July. And the developed markets in general would outperform emerging markets, inclusive of China. But if you exclude China, several emerging markets have been doing well and should continue to do so, such as India, and they would be more likely to perform in line with the developed markets. In fact, we have if you look at China, at EM ex China, it's been pretty much a market performer, similar to the developed markets.
Interesting. And a key feature, most of the developed markets are near all-time highs, and China has been doing particularly bad from an equity standpoint and also from an economic standpoint. So the next question is going to be on China. Recently, the nation unveiled stimulus to help its sluggish economy. What are the potential consequences and or benefits of this stimulus for assets?
Well, they did a similar attempt to support equities in 2015, and it didn't succeed. And it's been limited so far, in that we haven't seen the massive stimulus that would really turn around what has been the problem with China, which has been a lack of consumer and business confidence. China's been reluctant to provide too much stimulus because they don't want to create another bubble in property or in the market in general. So it had been limited, but this is keeping confidence very limited in that we don't have the foreign direct investment. We don't have, there's a lot of worry about regulation, government control, worry that the market, the idea that the market is uninvestable. So we're just not getting the market anticipating that we're going to see a sustained recovery in the Chinese economy. And until we start to see that, it would probably be a market that will continue to underperform.
Okay, and moving across the Pacific Ocean to the United States, here stateside, are you optimistic that U.S. earnings growth in 24 will gain roughly 10%, like market participants are pricing? Some headwinds are higher for a longer Fed, and also global growth slowing down. How do you feel about earnings prospects?
Well, earnings, we've had this soft landing, which is pretty much the ideal situation. Inflation's under control. Despite the little surprise we had earlier this week, the inflation trend is going in the right direction. At the same time, we're not going into a recession in the U.S. So, this is really supportive of earnings continuing to come through. The beat rate right now is about actually 81% of stocks have been beating expectations, which is down from 83%, with about 62% of the companies reporting. So, the earnings seasons have been coming through pretty well. The forward earnings, if you look at a year from now, it's like 11% earnings growth, similar to what you mentioned, on 10% trailing earnings. At this point of the cycle are negative 3%, but the point is they will trailing earnings will start to follow the forward earnings. And so unless some, major negative surprise is out there from a macro standpoint, which we don't see any signs of, well, then the earnings should come through. And I think 10% would be a reasonable expectation for the year.
And moving along to valuations, the forward earnings multiple is around 21 times here, or an earnings yield of 4.8%, compared to risk-free fixed income alternatives that present more attractive yields of upwards of 5%, albeit without the potential for earnings growth. Does valuation present downside risks?
Not at this point. I think, similar to what I mentioned earlier, if we have, stocks and bonds both moving together on the upside, stocks are going to be outperforming bonds. And then especially if the yields do in this phase of the monetary cycle, and we do see yields continue to fall, well, that benefit from bonds becomes less decisive. But I think the big point there is that the valuations in equities will be supportive as long as the earnings do come through. And it's when earnings growth starts to slow. And by that point in time, if we've had these earnings yields at these levels, then you have the potential for complacency and therefore disappointment. And then, then the valuations would become more of a problem for equities. But at this point, I don't think it's an immediate concern, but we do need to pay attention to it and, see if we're not at levels of valuation we'd had, you say, in 2021. But if we did, then that would start to become a concern. So yes, something we should be watching.
Speaking of wild cards and potential headwinds, how are you thinking about geopolitical risks, including Hamas-Israel conflict, the Red Sea disruptions that are going on, Ukraine-Russia? How is that influencing your outlook on the marketplace?
Well, the way to look at that is if it's, for example, the Ukraine war, when that broke out, is heading into that, even before it started, commodity prices were moving higher and it had an impact. Then that became the economic impact, and that had impact on commodities. But if it's more of a contained geopolitical crisis like the Middle East is at this point, that doesn't necessarily have to have an impact on the markets. It's when it has a bigger macro impact that it becomes more of an impact, has more of an impact. And we find that what we call crisis events, during a crisis event, the market tends to have an initial decline, but then a month later it's back where it was before the event started. I think we should think about the potential for a major geopolitical event such as Taiwan and China getting into a conflict, which would then have much bigger economic implications, which would be have a much bigger market impact. But we don't have to have these geopolitical problems, can be, as long as they're contained, they may have a short-term impact, but they don't, unless it gets to the point of having that sort of major macro impact, then it won't the markets will be able to tolerate that.
How are you assessing the impact of the record level of U.S. government debt, issuance, and deficits, and the potential for future government debt issues in your outlook for bonds? Particularly on the long end, some folks are concerned that that's going to be structurally higher in the medium term.
I think that does put a floor certainly under yields, but I think there was a lot of worry about that in October, but then yields came back down. And I think that what we haven't seen is really the kind of inflation expectations that are needed to get bonds into a sustained uptrend. But I would say the supply issue is providing a floor to yields, but we don't think yields are moving into a long uptrend. As I mentioned earlier, if the economy is slowing, well, yields will probably continue to recede as the Fed starts cutting rates. More of a floor, more of a supply. On this supply demand question, you have the supply supporting yields, but you don't have the demand to really, produced by inflation expectations to launch a major uptrend in yields.
Finally, our last question. What are possible headwinds and tailwinds in markets today? We spoke about a lot of them, but I'm curious as to what's top of mind for you.
Well, tailwind would be liquidity that will start to improve as the Fed and other central banks start cutting rates and moving from a tightening cycle to an easing cycle. That's the real tailwind here for the markets. We talked a little bit about valuations. A headwind would be if the market's gotten too complacent and has priced in too much good news, and you start to get more earnings disappointments. That would be a headwind. Also, remember, this is an election year. There's a potential for uncertainties or surprises to kind of keep the market choppy. We have a cycle composite that we put together, the 1, 4, and 10-year cycle, to sort of give us a roadmap for the year, and it suggests a fairly choppy uptrend. You have correction potential in May, September, October, but then after the election, there's pretty reliably a year-end rally, and over the course of the year, we see the market moving higher, as it's already started to do up to this point of the year.
Yeah, it's interesting. One thing that I've been thinking about are the pros and cons of the former president. He's doing pretty decent in the polls, but in the short term, he presents some risks to markets, perhaps via government shutdown. But in the more medium term, the market may benefit from a more deregulatory, lower corporate tax kind of regime. That's something that we've been thinking about here as well. And then also on what you said about China and Taiwan, some risks that come to mind there are, semiconductors have been on a really fierce rally to the upside, globally speaking, while China's equity markets have, been in the basement. So sometimes I wonder if, China is a little worried or jealous or concerned that they're not participating in that upside, and maybe that lays a framework for, a geopolitical event.
Yeah, I think that's something I point out quite a bit, is that if you look at these big tech stocks and you look at Alibaba and Tencent, unlike the U.S.-based tech stocks that have really been driving the benchmarks higher, those stocks have been weighing down the Chinese market. They haven't participated. So it's been sort of a regional, the impact. They haven't benefited from what has really helped the U.S., which has been its heavy weight in these big tech stocks.
Yeah, and sometimes I think about, folks being scared of having their money parked east in China, a government crackdown on capital controls or inability to get their cash out, and that's really driven more upside in Japan and Europe and the US. And it will be interesting to see how that continues to evolve in the coming months and years.
Yeah, I think that's right.
All right, Tim, thanks a lot for participating here at Interactive Brokers Podcasts. Check us out on your favorite channel for podcasts, Spotify, Apple Music, all of the above. Thanks a lot for being here, Tim.
Thank you, Jose.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.